The relationship between GDP and real estate. Real estate investing is all about making money off the value of property, but there's more to it than that. If you only think about the money side of the equation, you miss out on some of the factors that drive real estate values up or down. To get the most out of your real estate investments, you need to understand not just how much money you can make off them, but also how real estate values are affected by other factors in the economy, such as GDP growth and interest rates. What is GDP? Gross domestic product, GDP, is a measure of economic growth. It measures how fast a country's economy is growing by adding up all goods and services produced within that country's borders, regardless of who owns them. Because it encompasses everything produced in a country, GDP has become one of the primary indicators for determining how well an economy is doing. In fact, if you ask most economists, they will tell you that all other things being equal, an increase in real GDP means an increase in standards of living, i.e., better life. The idea behind measuring gross domestic product can be found in a 1926 book titled Measuring Business Cycles, written by economist Arthur H. Why does it matter for real estate investing? The health of an economy, not only real estate, but all kinds of companies within that nation's borders, is essential to your success as a real estate investor. Pay attention to economic indicators, such as gross domestic product, GDP, unemployment rates, housing starts, auto sales and other metrics that provide insight into what's happening in your local real estate market. Researching these factors will give you a sense for how sustainable housing values are now, and whether they may be about to increase or decrease over time. It could also tip you off to signs of overall financial trouble that would adversely affect growth in your region over a longer period of time. If there is a major recession coming, it might be better to wait until things improve before investing in real estate. How does it affect property prices? Gross domestic product measures a country's overall level of economic activity. While it doesn't provide much insight into what prices will do over time, that number could be positive or negative. It does affect property values for 3 reasons. 1. The higher GDP is, the more people there are earning money to spend on housing. 2. A higher GDP means stronger consumer confidence and therefore less uncertainty about future income. 3. A robust economy attracts foreign investment capital to our shores. All of these factors help increase demand for real estate, which increases property values. On top of that, though, many investors prefer properties in areas with higher growth potential, e.g., they may want to invest in Houston instead of Cleveland. By buying in markets with high GDP growth, they can benefit from rising property values and increasing rents without taking too much risk. On top of that, because most economists don't expect US GDP growth to go negative anytime soon, and usually predict steady gains, buying a home in a hot market can also protect against price drops when you need to sell later on down the line, as long as your own local market hasn't tanked at that point. Not only does economic growth affect prices, but business cycles can have an effect as well, although different types of real estate react differently during those cycles. If you liked the video, don't forget to subscribe to House Lux Estate for more real estate insights.